Hello, YouTube. This is Dr. Dave Maslach talking to you about Reciprocity.com, the sharing economy proofreading platform, the ease, but with the three. So today I actually wanted to talk about I think is a pretty interesting article by Elizabeth Pontikes and Bill Barnett so Elizabeth is at University of Chicago and Bill Barnett is at Stanford, and they wrote this really interesting paper about venture capital. So I'm a professor of innovation strategy and entrepreneurship, and I thought I would first talk about what is venture capital, what is angel investors, and what was the really interesting finding that they identified or what they were getting at in this video. So what is venture capital? Venture capital is a group of individuals, so it's usually private investors that get together, they sink some money into a fund. This fund, they take a portion of this fund and then they start divvying it out into little bits into different firms. It could be sort of smaller firms or firms that are just starting out or that are gaining what is called traction, or ones that have been around for a long time and then they're growing rapidly. What they're looking at is sort of high growth opportunities. And I'm not talking about, 8, 10, 12%. That is what you can get in the stock market. That is what you can get in the S&P 500. They're looking for 10 to 100 times as the growth of currently what it is. They're looking for what's called 10x, right? So that if a company is worth $1 today, in a year's time they want to have it worth $10 or $100. So you can imagine if you scale that, that gets really, really big very, very quickly. That's what the kind of returns they're looking for. Something very rapid growth, right? So there's also this other term that we hear about as well. It's called angel investors. This is slightly different, but very similar. This is where there's generally a single entrepreneur or a single investor that has a significant amount of wealth, and they're divvying it out, and they're giving a small portion of this wealth to generally very, very new startups, something that is just growing. So they might get $10,000, maybe they give $20,000 to something that is just starting out and they think it might grow. And that's exactly what they're doing. So here's the interesting thing that Elizabeth Pontikes and Bill Barnett found in what the paper was talking about. This is really, really cool stuff. So they found that there's hot trends and slow trends in venture capital. That is not necessarily all that new and novel. We have known, business researchers have known this for a long time, that there's these hot and very, very, one moment. So right now in 2017, VR, virtual reality, is a really hot thing. A few years ago, it was stuff with genetics, for example, was a really hot thing. A few years back, before that, it might have been, anything with the app-based economy, for example. There's all these sort of trends that change over time, and every single year there's something new and big and hot, and people are really excited about. So here's the thing: when that happens, that creates sort of a buzz with the venture capitalists. They kind of talk. I mean, everybody talks, right? Everybody gets out there and they have coffee. And when they have coffee and they talk to each other, they say, this is a really hot and interesting thing. Then they're more likely to invest in those particular companies. So you might get a boom in that particular company, and they might get more investment. So here's the interesting thing that happens. Those companies that are unable to get that venture capital funding, they actually are more likely to survive in the long run, and they're more likely to prosper in the long run. So why? Right? Why is that the case? Well, the reason that there is a selection mechanism going on. Those that have a hard time getting that investment, they are probably, and they survive, right? So the ones that have a hard time getting that investment and they survive, they're probably the ones that were better off in the first place. So what happens is the ones that are getting all this money, it's hard to sort of tease apart the ones that are not so good and the ones that are really good. And there'll be more of those ones that are not so good getting money, and they're able to survive a little bit longer, but then they they disappear, right? So the ones that don't get the money and they keep going and and keep plugging along and keep plugging along, those are the ones that are going to survive in the long run, and they have sort of a long-term sustainability built into them. I think that's really, really interesting ideas. It speaks to the power of just sticking with something and continuing with something. Um, that if you, even if you don't get any sort of venture capital funding or anything like that, but just continuously to stick with something means that you have a higher chance of survival if you just keep grinding at that and you're good with your money and you do things as cheap as possible and grind away. You have a very high chance of survival and then maybe have some success in the long run. So even if you see somebody getting venture capital funding and all that kind of stuff, it doesn't necessarily mean that you're any worse off. Sometimes it means you're better off, right? So that's a really cool, powerful idea. It's something that gives you some motivation to keep going and keep pushing forward. And that's exactly what I want you to do, is just keep pushing forward, keep grinding away. Don't spend a lot of money. Focus on trying to be as cheap as possible for the long haul, and just focus on trying to generate revenue as much as you can and grow that revenue, and you will eventually get there. It just takes time, it takes a lot of grinding, and just keep focusing on that. That's exactly what you have to do. And I know that you can do it. It's a very powerful idea. And that's all you have to just keep focusing on. Just keep grinding away and keep grinding away. And you know what? If it doesn't pan out and you don't make any revenue or anything like that, that doesn't matter. It means that you tried. At least you tried, and you continue to grind away at it. So caveat, if you are grinding away and this is your thing and you're not making any money, this is the only thing you're doing, maybe you should sort of switch or get a side job, right? So focus on having a main job and then moonlighting at the same time, trying to grow whatever it is you're growing, because that is that you need to get that revenue in from that particular thing that you're growing before you can jump into it and sort of invest more and more into it. So that's all I have to say. If you like these videos, make sure you do subscribe to the channel. If you like this particular video, do one of those, you'll thumbs up. As well as you want to help out with reciprocity, you need sort of proofreading done or anything like that, go on to the website. The E is spelled with a 3. Check it out. It's going to help science. It's going to help doctoral students in this area. I'm really excited about it. So check it out, and I will see you on the next video. Bye. Take care.